Hey everyone, welcome to another deep dive, this time into the world of high-frequency trading and market making.
Yeah.
We're going to be exploring something called inverse variance weighting,
Hmm.
and it's all about balancing risk and reward, and we'll see how that applies um, to these fascinating fields of trading.
Yeah, for sure.
So today's deep dive is going to be based on a couple of excerpts.
Okay.
One's called A Tale of Symbols Optimization, and the other one's called Inverse Variance Weighting.
All right.
And you might be surprised by just how elegant and simple this algorithm is.
Yeah, I could see that.
It's like a secret code that helps you understand how markets work.
Yeah.
To kick things off, one of the sources describes a trading algorithm as like a symphony,
Oh, wow.
with orders, prices, and trades acting as musical notes.
Hmm.
What do you think about that analogy?
Well, I think it does a good job of capturing the dynamic and interconnected nature of markets, right? Like
Right.
each action kind of contributes to the overall composition of the market.
Right? Like each trade, each order, each price movement,
Exactly
like a
that.
note in the symphony.
Yeah.
Okay, I see where they're going with that.
Yeah.
But a symphony usually follows a score.
Right.
Markets, on the other hand, are like,
Yeah.
they feel a lot more unpredictable,
Definitely.
kind of chaotic,
For sure.
like a jazz improvisation.
Yeah. I like that. That's a great point. There's definitely that element of randomness, but like jazz, there's some underlying structure and patterns
Right.
that, skilled traders, they try to identify.
Exactly. And that's where these algorithms come in, right?
Yeah.
To provide a framework.
Exactly.
Now, the source also uses a lot of symbols
Yeah.
to represent these really complex market concepts.
Right.
It's almost like they're speaking a secret language.
Mm.
How do those symbols help us understand inverse variance weighting?
Yeah, they're great for abstraction. So these symbols like sigma for variance or W for weight,
Right.
they allow us to represent complicated market phenomena in a simplified form, you see? And this actually makes it easier to analyze and manipulate.
So it's kind of like
Yeah,
using shorthand to
exactly.
express a big idea.
Yeah,
Okay. But I got to admit, I'm a little intimidated by mathematical formulas,
right.
even with the shorthand.
I hear you.
Can we break down this inverse variance weighting formula
Of course.
in a way that even I can understand?
Absolutely.
But-
So the formula itself, it's surprisingly straightforward. It tells us how much weight we should assign to each asset.
Okay.
And the key is that this weight, it's determined by the inverse of the asset's variance.
Okay, so the higher the variance, the lower the weight.
That's right.
Got it.
You got it.
So it's like saying,
Yeah.
hey, this seems a little too risky.
Exactly.
We're not going to go all in on it.
You're essentially spreading your risk
Okay.
by favoring those assets with lower variance.
Gotcha. So you don't want to put all your eggs in one basket.
Exactly.
You're diversifying.
Yeah, and just to make sure that you're not over allocating, we normalize these weights, and all the weights add up to 1,
Right.
which represents 100% of your investment.
Okay. So in simple terms, inverse variance weighting.
Yeah.
It's all about balancing your portfolio
Yeah,
to minimize risk.
precisely. It's a foundational risk management strategy,
Uh-huh.
and despite its simplicity, can be incredibly effective.
Right.
Yeah.
Wow.
Mm-hmm.
This is all starting to make sense, but how does this actually play out in the real world?
Right.
Let's say I'm a trader and I have a few assets.
Yeah.
I've got their historical returns.
Okay.
How would I apply inverse variance weighting?
All right, so let's imagine you've got 3 assets, A, B, and C,
Okay.
and you've analyzed their historical return data,
Yep.
and you calculated their variances.
Okay.
Asset A has the lowest variance, meaning it's been the most stable.
Mm-hmm.
Asset B has a moderate variance.
Okay.
And asset C is the most volatile. It has the highest variance.
Got it.
I guess
So following the formula, asset A would get the highest weight because it's the least risky.
yeah, that is exactly right. Because it has the lowest variance, the reciprocal of that will be the largest,
Right.
giving it the biggest piece of the pie,
So to speak.
so to speak.
Okay.
Asset B gets a moderate weight,
Right.
and asset C, being the riskiest, would get the lowest weight.
So you're not completely ignoring those riskier assets.
Yeah.
But you're definitely not going all in.
Exactly.
Gotcha.
You got it.
Okay, so why is this seemingly simple concept so important?
Right.
Especially in like the fast-paced world of high-frequency trading,
Yeah.
it seems almost too simple
Right.
for such a complex field.
Well, you've hit a key point there, because in high-frequency trading, decisions are made in milliseconds.
Yeah.
You need algorithms that are quick, efficient, and transparent.
Right.
Inverse variance weighting, it fits the bill perfectly.
Okay.
Computationally inexpensive, it's easy to understand, and it directly addresses risk,
Right.
which is super important in such a volatile environment.
So even in that whirlwind of market data,
Yeah,
this simple formula can help traders make smart decisions.
absolutely. Imagine high-frequency traders. They're trying to make split-second decisions about what assets to buy or sell.
Yeah.
They need an algorithm that can rapidly assess risk and adjust the portfolio weights accordingly.
Right, to avoid big losses.
Exactly. And inverse variance weighting gives them that capability.
Wow, that makes a lot of sense. I'm also struck by the fact that we're using these abstract symbols
Right.
to make real-world decisions
Right.
that impact actual money.
Yeah.
I mean, it's kind of mind-boggling to think about.
It is quite remarkable, but that's the power of abstraction, right? It allows us to take something as complex as market risk and represent it with a symbol like sigma squared.
Right.
And this simplification enables us to compare different assets, each with its own unique risk profile,
Yeah.
through this single lens of variance.
So it's like finding a common language to analyze all these different aspects of the market.
Exactly.
We're not just looking at individual stocks, we're understanding them in relation to each other
That's right.
through this idea of variance. But earlier we talked about how markets aren't always predictable.
Right.
Wouldn't relying solely on historical data to calculate variance be kind of problematic?
That's a sharp observation. You're right, relying solely on past data to predict future variance.
Yeah.
It can be risky, especially in these rapidly changing markets that we're seeing now.
Yeah, so how do traders account for that? Do they
Right.
just throw this whole inverse variance weighting thing out the window?
No, not quite. While inverse variance weighting is a powerful tool,
Okay.
it's not a silver bullet. Savvy traders understand its limitations and often use it as a starting point,
Okay.
a foundational element in their, more complex trading systems,
Gotcha.
right? They factor in other variables, adjust their assumptions, and sometimes they even turn to more advanced models
Right.
to handle those tricky situations.
So it's like using a basic map to navigate a new city.
Exactly.
Gives you a general lay of the land,
Right.
but you might need more detailed directions or real-time updates to find your way around.
For sure.
Okay, so how do those detours manifest in the market world?
Those detours often come in the form of asset relationships.
Like,
How the prices of different assets move in relation to each other.
right, like is it correlated or?
Exactly. And that brings us to the concept of covariance.
Covariance.
Yeah, have you heard of that term before?
Yeah, I've heard it thrown around.
Essentially, covariance measures how the returns of two assets move together.
Okay.
Do they tend to move in the same direction, opposite directions, or are they completely independent?
So it's not just about how much an asset's price jumps around,
Right.
but also how it dances with other assets in the market.
Precisely. And this dance adds another layer of complexity
Right.
to inverse variance weighting, because now the risk of your portfolio, it's not just the sum of individual asset risks.
Right.
It's affected by how those assets interact.
So two assets that individually seem stable with low variance could actually make my portfolio riskier if they tend to move in opposite directions.
That's the thing about markets. They often defy intuition.
Right.
And you're right, those seemingly stable assets, when combined,
Yeah.
could create more volatility than you'd expect if their price movements are negatively correlated.
Yeah, that seems counterintuitive. Okay.
Right. On the other hand, two assets with individually high variance might actually offset each other if their movements are inversely correlated.
Right. Okay.
This is where the real art of portfolio management comes in.
This is starting to sound a lot more complicated than just plugging numbers into a simple formula.
Yeah, you're not wrong when we start factoring in covariance.
Oh, wait.
We're stepping beyond that basic inverse variance weighting formula into the realm of more sophisticated techniques.
Right.
Things like quadratic programming, factor models, and even machine learning.
Wow.
These approaches help us account for the interconnectedness of assets and build portfolios that manage risk even more effectively.
So we've gone from a single instrument to a whole orchestra of mathematical tools.
We have.
But even with those more advanced techniques,
Yeah.
that core principle of abstraction, using symbols to represent these complex interactions, still seems crucial.
Absolutely. It's the foundation upon which we build those more sophisticated models.
Right.
But even with all these fancy tools, we can't lose sight of the human element.
What do you mean?
Well, algorithms can process vast amounts of data, identify patterns we might miss, but they can't replace human judgment.
Yeah.
It's ultimately the combination of quantitative analysis and human intuition.
Okay.
Understanding market sentiment, geopolitical events, and those intangible factors that algorithms can't fully grasp.
Yeah.
That leads to the most effective trading strategies.
So it's a partnership
It is.
between the machine and the human mind.
Exactly.
Okay, amidst all this complexity,
Right.
what are some of the real-world implications of inverse variance weighting?
Okay.
How is it actually being used in practice?
Great question. Inverse variance weighting plays a vital role in various areas of finance, particularly in high-frequency trading and market making.
We've talked about high-frequency trading.
Yeah,
What about market making?
right.
How does inverse variance weighting fit into that?
Market makers are essentially the facilitators of smooth trading.
Oh.
Their role is to provide liquidity by continuously quoting prices for both buying and selling assets.
Right.
They need to manage their inventory carefully to avoid accumulating too much risk.
Yeah.
That's where inverse variance weighting comes in.
So they're using this technique to make sure their own portfolios stay balanced,
Exactly.
even when the market's going crazy around them.
Imagine a market maker dealing with hundreds or even thousands of assets.
Oh, wow.
Right? They need a way to dynamically adjust their positions based on the relative risk of those assets.
Yeah.
Inverse variance weighting helps them do that,
Right.
ensuring they don't get caught holding too much of a risky asset when the market takes a downturn.
So it's like a built-in safety net, protecting them from those big swings in the market.
Exactly. And by managing their own risk effectively,
Yeah.
market makers contribute to the overall stability and efficiency of the market.
Wow.
Right? They ensure that buyers and sellers can always find someone to trade with, even during those times of high volatility.
I'm starting to see how this seemingly simple concept of inverse variance weighting
Right.
has these ripple effects
Yeah.
throughout the entire financial system.
That's right.
It's not just about individual traders trying to make a profit.
Right.
It's about creating a more stable and efficient market
Exactly.
for everyone.
That's right. And it all goes back to that fundamental principle of balancing risk and reward.
Yeah.
That's the key takeaway here. Whether you're a high-frequency trader looking to capitalize on market fluctuations or a market maker trying to keep the system running smoothly,
Right.
understanding and managing risk is paramount.
This is all so fascinating, but I have to admit, I'm still surprised by how much depth there is to this concept.
Right.
We started with a simple formula. Yeah. But it's clear that inverse variance weighting has these far-reaching implications.
It's true, and we've only just scratched the surface. There's a whole universe of mathematical and financial theory behind this concept.
Well, before we get completely lost in that universe,
Right.
there's something you mentioned earlier that really caught my attention.
Okay.
You hinted that the principles behind inverse variance weighting might have applications beyond the world of finance.
Yeah.
That's a pretty intriguing idea.
It is, isn't it? And that's explored a little bit in the source material.
I have to admit, when we started talking about inverse variance weighting, I was picturing like spreadsheets and algorithms,
Right.
not life decisions.
Right.
But now that you mention it, this whole idea of balancing stability and volatility,
Yeah.
it seems pretty relevant. Just about everything we do,
It really does.
like in our everyday lives.
Yeah, think about how we approach risk in our personal lives, right?
Right.
Some people are naturally more risk averse. They prefer stability and predictability.
Right.
Others, they embrace volatility. They seek out new experiences and challenges.
So are you saying that some people are like hardwired to be low variance?
Yeah.
And others high variance?
Not necessarily hardwired, but our personalities and experiences, they definitely shape our risk tolerance.
Okay.
And just like in a portfolio, we often seek a balance between those two extremes.
Okay, that makes sense.
Yeah.
We might have a stable job
Right.
that provides consistent income. That's like our low variance asset.
Exactly.
But then we might also have like a side hustle or invest in a riskier venture.
Yeah.
That's our high variance play.
Exactly. And the way we allocate our time, our energy, and our resources between those different pursuits,
Yeah.
that reflects our own personal inverse variance weighting strategy.
So are you suggesting that we could actually apply this formula to our everyday lives? I mean, I'm not sure I'm ready to start calculating the variance of my hobbies.
Yeah, probably not about crunching numbers in a literal sense.
Okay.
But the underlying principle, you see, understanding the trade-offs between stability and volatility and finding a balance that aligns with our goals and our risk tolerance,
Right.
that's universally applicable.
Okay, so instead of obsessing over historical returns and calculating variances,
Yeah.
we're looking at the potential risks and rewards
Exactly.
of different choices
There's different choices in our life.
in our lives. Okay, let's say you're considering a career change.
Okay.
The stable, well-paying job might be tempting.
Right.
That's our low variance option.
Right.
But then there's the new, more challenging role.
Yeah.
Even if it comes with some uncertainty,
Yeah.
might offer greater growth potential.
Right.
That's the high variance play.
Exactly.
So just like in finance,
Yeah.
we'd be trying to create a portfolio of experiences and opportunities
Yeah,
that balance stability and risk.
that's right.
But how do we know how much weight to give to each side?
Right.
That's where things get tricky.
There's no one-size-fits-all answer, right? It depends on your individual goals, your risk tolerance, and your circumstances.
Right.
And just like in the market, the optimal balance can shift over time as your situation evolves.
This is really making me think about all the different ways we navigate risk and reward in our lives.
Yeah.
It's not just about money. It's about relationships,
Yes.
health,
Yeah.
personal growth, everything.
Think about how we approach relationships, right?
Right.
Some people seek stable, long-term partnerships.
Right.
That's their low variance approach.
Right.
Others, they thrive on spontaneity and new connections.
Yeah.
That's their high variance strategy.
Makes sense.
And there's no right or wrong answer. It's about finding what works for you.
So what you're saying is that this concept of inverse variance weighting, something that we usually associate with finance,
Right.
actually reflects a much deeper truth about human nature,
Yeah.
our constant balancing act between stability and volatility.
That's a great way to put it. And I think that's the real takeaway here.
Yeah.
Whether we're consciously aware of it or not, we're all constantly making decisions that reflect this principle.
This has been such an eye-opening conversation.
Yeah.
I'm starting to see inverse variance weighting everywhere I look now.
Right.
So to our listeners, I challenge you to consider how this concept might apply to your own lives.
Yeah.
Where do you seek stability? And where do you embrace volatility?
Right.
How do you balance those competing forces?
Mm-hmm.
It's a fascinating question to ponder.
And as we've learned today, even a seemingly complex concept like inverse variance weighting can be broken down into simple principles that have universal relevance.
Yeah.
So don't be intimidated by the technical jargon.
Right.
Focus on the underlying ideas.
Right.
And you'll find that they have the power to inform your thinking and decision-making in
Right.
all sorts of unexpected ways.
Well said. A huge thank you to our expert for guiding us through this fascinating deep dive.
The pleasure was all mine.
It's been a real pleasure exploring this topic with you. And to our listeners, thank you for joining us on this journey of discovery. We hope you've learned something new, gained a fresh perspective, and perhaps even been inspired to think differently about risk-reward and the delicate balance between the two. Until next time, keep exploring, keep questioning, and keep diving deep.